Hi, and welcome to Financial ChitChat. My name's Jerry Hill, and I am your host. Today I want to talk about the pooling of risk. A lot of people will tell me, hey, all I do is pay insurance premiums. Time and time again, that's all I do. The insurance premium always goes up. Why is my insurance going up all the time? And by the way, it just seems like it's a bad investment. And what I explain to them is insurance is not an investment. Insurance is something that it is definitely a cost, like electricity or gas. It's something that we need, and it's something that prudent people have in case something does go wrong. It's actually a really good thing if all you're doing is paying insurance premiums, because that means you're not having a claim, and that's a good thing. You don't want to have a claim. Claims are a headache, they're stressful, and at the end of the day, understand that our insurance is never an investment. It's really based on the pooling of risk. And what that means is insurance companies will take a couple thousand homes in a certain city, they'll put them all together, and they'll collect a premium. Their premium that they're charging these homeowners is based upon the pooling of risk, meaning, hey, how many losses are we having for this pool of risk that we're insuring? And based on the losses, are we bringing in enough revenue from the premiums to justify what we're charging? And so as you're pooling risk, that's essentially how insurance premiums come about. For an insurance company to get a raise in premium, they first have to go through the Department of Insurance. The Department of Insurance then looks at the reasoning for company XYZ to raise their auto insurance rates and either approves it or says, no, you didn't give us sufficient evidence, you need to go back to the drawing board, submit new numbers. And the numbers that the insurance companies are submitting to get the rate increases, it's based on the pooling of their risk. Based on thousands of people, this is what type of, what they call it, a loss ratio. This is the type of loss ratio that is taking place. That loss ratio is just, hey, how much have we paid out versus how much have we brought in? And then they come up with a premium. So it is correct. Look, insurance is, for the most part, and I'm kind of breaking it down as simply as possible, it's not an investment. It's a necessary expense to help us cover our assets to make us whole in the end. And that's really what insurance is made for. The insurance industry calls it indemnification, meaning I'm going to be made whole, just like I was before the loss occurred. That's the goal of every insurance company, is to make you whole, to indemnify you in the event of a loss. And so I hope that helps. Now, I also hope it helps, understanding that these insurance companies cannot just randomly raise their rates without going through the Department of Insurance and getting that rate approval as well. And that's all done by the numbers. It's done by looking at the pooling of risk and then coming up with what their loss ratio is. How much money have they paid out in claims versus brought in premium? I hope you find that helpful, and I hope you have a great day, and I will see you soon. Thank you.